Okay, hi. So someone had posted a question on the discussion boards about not understanding what over applied and under applied overhead is. So I decided to do a quick video because it's much easier to explain it this way. So basically, uh, you don't know your actual overhead cost until at the end of the period. You don't know how much these costs are going to be until you actually incur them. But as you're producing product and stuff, you want to allocate a cost to those products. So you estimate what you think your overhead is going to be. Now you can estimate it based on various things. So in chapter 5 at the beginning, they talk about predetermined overhead rates. It can be based on, well, here we're going to look at examples of machine hours, materials, cost, but whichever one of these costs the drivers that tend to drive the cost itself is what you're going to use. So basically you go through the year using your estimate, and then at the end of the year you have your actual, and then what you're doing is you're comparing your estimate to your actual, and from there you're going to see then if you over or under applied your overhead. So it's just basically how much was your estimate off of your of the actual amount. So an example here, this is on page 159 and 160 in your text. So this company, so Turbo Crafters, so they're going to base their overhead on machine hours. So that's their cost driver. So they estimate their overhead to be $300,000, and their allocation base, which is machine hours, they estimate to be $75,000, which means their predetermined overhead rate is $4 per machine hour. So Black and Howell, on the other hand, they are using a overhead rate based on direct materials cost. So they are estimating $120,000 in overhead, and $80,000 is their allocation base, which is direct materials cost. So their predetermined overhead rate is 150% of direct materials. So they do this at the beginning of the year, and then as they're creating product throughout the year, they allocate overhead based on these amounts. So then you get to the end of the year. So Turbo Crafters, at the end of the year, they actually only used 68,000 machine hours. So they had allocated it based on 75,000, but they only had 68,000, so there's a difference there. And their actual overhead cost ended up being 290,000, where they had estimated 300,000. So because of that, like I said, this is based on estimates, and this is your actual. So you use your best guess at the beginning. You allocate your overhead out throughout the year. And then at the end of the year, you say, okay, our numbers were a little different. So our actual overhead was 290,000, but throughout the year, we had applied our manufacturing overhead to work in process throughout the year. We had used the rate that we had determined up here, $4 per machine hour, and there were now that's 75 and 300,000 here. That's just used to determine to get this $4 per machine hour. So that's your estimate, $4 per machine hour. And then it would have been allocated throughout the year as actual product was produced. So they would have allocated 68,000 machine hours at $4 per hour. So it would have been 272,000 that would have been charged to overhead. That would have been applied there to your work in progress. So they should have applied 290,000. They only applied 272,000. So they applied less than what they should have. So they under-applied overhead by 18,000. Whereas Black and Howell, their actual manufacturing overhead cost ended up being 130,000. They had estimated 120. Their allocation base, they had estimated they would use 80,000 in direct materials cost. It ended up being 90,000. So they had higher manufacturing costs and a higher allocation base than what they had estimated. So again, we're going to compare the actual, so their actual of 130, to what they would have charged during the year based on the estimate. So the estimate was 150% of direct materials costs, which is what we calculate here. And throughout the year, there was $90,000 in direct materials costs. So for every dollar that they had in direct materials cost, they would have had a predetermined overhead rate of 150% of that. So they would have applied $135,000. So their actual that they should have applied was 130. They ended up applying, based on their estimates, 135. So therefore, they applied $5,000 more than they needed to. So they over-applied their overhead. So the things to keep in mind is you're using the estimate of their overhead and the estimate of the allocation base to determine the predetermined overhead rate. Then you apply that rate to the actual allocation, because so say in month one, for this company, say in month one, they actually used 5,000 machine hours. So in month one, they would take 5,000 machine hours at $4 per machine hour, and they would use that amount. In month two, they would take the actual amount of the allocation base. They would take the actual, but they would multiply that by the estimate of the predetermined overhead rate. So once you calculate your rate, then forget about these estimates. You use your actual amount of your allocation base times your predetermined overhead rate throughout the year that would have been applied, and then at the end of the year you're going to look and say, well, our actual was this is what was applied during the year, so did we apply too much or did we apply not enough? And that will be your under or over applied overhead. Okay, so hopefully that answers your question.